Welcome, everyone. Thanks for joining to hear a little bit more about what we're up to at Wunder Capital. So just to introduce ourselves to anyone who has no idea what we do, we are the leading marketplace lender in the U.S. solar market. So in the same way that you can go into Lending Club and help people predominantly flip over their credit card debt, you can come to Wunder Capital and connect with borrowers who are putting up solar projects around the country and finance those loans through our funds and earn a projected return. So the loans that we make to those businesses, municipalities, hospitals, schools, universities are all asset-backed with the solar system as collateral. So that's one of the unique things that we do and one of our specialties, and talk a little bit about that more and how important it is. And I did just mention that we're working with businesses and schools and hospitals, not with homeowners. And the reason is simple. It's that the residential market works really well with FICO scores. There's not a lot of homeowners that the investment markets find creditworthy that have a hard time going solar today. And we'll talk about later a little bit of what difference that's created in terms of growth between residential and commercial. But we find that the real need in the solar market is commercial, and municipalities, schools, hospitals, et cetera, not homeowners. And we have 155, actually a little more than that now, partners in over 30 states that are out there every day. They're your local solar installer that's might be advertising locally or walking around in neighborhoods trying to get folks to go solar, when they're working with not homeowners again, but businesses or nonprofit entities. They offer our financing packages alongside those projects so that they can pay down those systems over time with their cost savings from electricity instead of have a big upfront cash payment. And it really helps them get those projects done. And this is a $5 billion annual financing market for folks that aren't familiar with what's going on in solar these days. It's really a large scale industry every year that, again, is in real need of capital. And we're working to make sure it's there, but also give our investors a great projected yield. So before we go into more of what we're up to, wanted to introduce ourselves to kick off. We actually want to talk a little bit about what's going on in the solar market. So much of why we're excited about bringing this opportunity to investors and being in this space is because we are really, really, really excited about what's going on in kind of a 5 to 10 year time frame in the US solar market and really in the global solar market, and what that means for investors, but also for the environment. So jumping into some of those high level numbers, one of the things that I think shocks people the most when they haven't been living and breathing solar is how much solar is contributing of new capacity brought online to the US grid each year. So we often hear how much of electricity generation is any given source, but it's really an odd way to think about evaluating where the industry is, because these things are built over 40 to 50 years. Electricity generation facilities have 40 to 50 year lifetimes. So really, when you look at the snapshot of what's being produced, you're asking what's the blended average of the 70s, 80s, 90s, aughts, and the last 8 years. When you look at when there was capacity that needed to be added that was new in the last year, what was added, that really answers what's price competitive today. And what's so exciting is that in 2016, and we'll see where 2017 falls out, but solar was actually bigger than natural gas, despite this fracking revolution that we hear so much about. And I think what's also interesting is if you look to the graph on the right, how much solar has grown just in the last few years. You can see only 6, 8 years ago is single digit percentages, and now it's the plurality of new capacity being added. And the obvious question is what happened there? And the simple answer is falling cost. And more places where solar is cost effective and bigger discounts. So we mapped here really the last 40 years or so, and again, soon to update with 2017 numbers that aren't quite out, but you can see just how dramatic this cost decrease has been and how consistent it's been. If you put this cost decrease on a logarithmic y-axis instead of a normal one as we did here, it's actually a fairly straight line with about 10% cost decreases every year, continuing 50% cost decreases the last 5 years, as you can see here on the right. And frankly, for a long time, as you can see in green and how many installations were happening around the globe, it didn't drive a lot of growth. And the simple reason is it was still a lot more expensive than hydrocarbons. Going from 10x more expensive to 5x more expensive than utility power doesn't do you a lot of good in this market. However, in the last 10 years or so, you can see this really dramatic spike of solar installations based on really, in more and more geographies, solar being a cost-effective decision, irrespective of your feeling about the environment or clean energy or carbon-free power. And we've seen this explosive growth. And the thing I think that is really exciting is we're just in the early innings of this growth. We're still not servicing the bulk of the US market. Solar still needs to fall in price. So, this story will continue running, we think, for at least another decade. Going back to something I kicked off with, which is why there's not much need for us in residential. This is the relative growth rates over the last 4 years. Again, about to get 2017 data, but over the last 4 years in the big three markets in the solar space, which is residential on-site, commercial on-site, and industrial, and some of those nonprofits and municipals that I talked about all kind of grouped into commercial, and then large utility scale systems that are competing directly with coal and natural gas plants. And what you can see here is that 50% price decrease that I talked about in the last 5 years has grown really, really explosive growth across residential and utility, I think, as you'd expect. And we look to commercial, it's a great growth rate for any other industry, but in solar, it's really been a laggard. And the more and more we dug into that problem, what we found was that really big commercial systems could get financed, investment grade systems could get financed, but your average stuff that you see around your area, the strip malls, the 2, 3, 4-story commercial real estate where you probably get your teeth cleaned, that stuff was not getting done. And largely it was because there wasn't a really turnkey process like FICO that made both the underwriting and then the execution of those deals really seamless and fast and easy. And that's why we launched Wunder, really to jump into this problem you see here on this graph and do our best to have the commercial market have really the capital availability that allows it to grow in the same way that the residential space has. And again, on the flip side, for our investors, we think that we are delivering some really strong projected returns, partially because there's a real market inefficiency that we can go in and both fill in a positive way for businesses, but also we think deliver some great dynamics to our investors where there's not a lot of other people doing this right now. Speaking a little bit more to that, we're in the early innings of this kind of progression into the US market. We decided to map, because so many folks are concerned about where the subsidies are going to be and how that falls out. We decided to map what the price of solar is without subsidy and the states in which solar is cost effective today, and then what that will look like over the next 6 years or so with expected price decreases. And so basically today without subsidy, it's a relatively small cohort, to be honest. You need to be about above 15 cents. Luckily, California, most of California applies, and as most of you probably know, by itself, it's the 5th or 6th largest economy in the world. So it's nice to have California in your 5-state cohort in 2017 that with no subsidy solar makes sense. But what's so exciting is that whatever happens on the subsidy front through the next 5 years, if we see that 50% price decrease over the last 5 years replicated in the next 5, literally the entire US market opens. And that is just an outrageously, I think, exciting time for us and a critical time for us as well. It's well timed that solar is finally getting to the point that after these 40 years of cost decreases, we saw a few slides back, that you really can walk into more and more consumers and simply say, this will save you money. And it's great when people care about the environmental side of it, but of course, it's a much bigger market when you can simply deliver economic savings and the environmental side is a plus. So speaking now a little bit to Wunder and what we've been up to, that green line there is our investments issued. So you can see we've had some fairly spectacular growth in the last couple of years. And really have just widened our offerings, gotten into self-directed IRAs. You can invest directly into solar projects around the country, into these diversified funds of our portfolios we put together, launched trust and company investments for folks that have investments structured in that way. And our most recent fund, which I'll talk a little bit more about in a second, is a 7.5% projected yield, a 5-year projected term for the investor, and that has a 20-year amortization curve. So you're getting a little bit of principal back over time, but mostly you're getting interest payments at that projected 7.5 level. And we have hit every single projected payment we've ever had across our 5 funds. That said, past performance, no guarantee of future returns, et cetera, et cetera. Just to speak a little bit more to kind of what opportunity we're servicing and flush out that kind of frame up that I had earlier of you've got your investment grade, you've got your Apples and your Microsofts and your CVSs, and they can go get systems finance fairly easily. I think we would all expect, and we found that to be true. At the same time, if you have a really big project, you can generally get a bespoke project finance firm to come in and underwrite that in a fairly manual way. But what we saw was that really all of those solutions stopped around a $1.5 million project size. And you say, okay, well, that's interesting. That might be a problem. It might not be. We are software folks, so we think, okay, can we reduce the fixed costs or the inefficiencies to reduce that? But the big question is, how much of the market is underserved by that limitation of the market today? How big a problem is that, in short? And we went and grabbed the U.S. Energy Information Administration data on what the median U.S. business, not even a small business, just an average 50th percentile business, consumes in terms of electricity, and how big a solar system they would need to generate all of that power. And it turns out the average U.S. business with average pricing and average power rates needs about a $175,000 system. And so you're talking about a market that's really not servicing the vast bulk of US businesses. And that's where I think we see that great opportunity to both serve businesses really well, but also bring investors kind of a rare and underserved market that we certainly are aiming to deliver outsized risk return on, or projecting that. So as I say, that's our market opportunity. That's our investors' market opportunity. And frankly, that's all of our I think opportunity in the US to grow our solar market a lot faster, because we were looking at that graph of growth rates. What wasn't on there is that the commercial and industrial market is roughly the same size as the residential market in terms of how much electricity we consume, and therefore how much carbon emissions we have. So this, we think, is really the big outstanding lever, particularly, certainly in the solar market, potentially more broadly, to bend our carbon curve down. Just to speak to kind of where we are today and where we're going, we are servicing a broader breadth of this market as we grow. That's absolutely our intent. And I think what's exciting about that is there's great business opportunity and great credit throughout these system sizes. Great example, we did some California-based municipalities that had spectacular credit. Buildings weren't that big, relatively small systems. What's exciting for us is we've actually automated our system to the extent that we can get down to that average system size of 175,000, where again, people that aren't using software, not automating this process in important ways, while keeping underwriters always doing the risk evaluation, they can't go below 1.5 million. So, we're really excited to be able now to go down to basically the median business, and hope to drive that even further into smaller deals as we go forward. Just to circle back to a point I made at the start, which is that these loans that we're making to these entities are always backed by the only claim against the solar project. So in the case that our borrowers don't pay us, we have collateralized, perfected that collateralization, filed liens against that asset in such a way that we can come in and take ownership of those assets in the case that someone, God forbid, defaults. As I mentioned earlier about our payment record, we've never had a write-off a loss or an uncured default, but I'm sure it'll happen at some point. And I think it's really important that investors understand what happens in that case. What's maybe not intuitive to folks, at least when we talk to them, is that I think when you think of a solar system, you think of a piece of equipment, you think of hardware, and you might think you're going to recover value on that in the case you have to take ownership, the way you might other capital equipment, construction equipment, or auto, where you would own it and then take it to some secondary market and try to sell it. And it turns out that's actually a really terrible recovery strategy for solar. What you want to do in solar, and I think first publicly reported at least by Solar City in 2014, getting 81 cents on the dollar in the case of default through this method, what you want to do is think of it as a stream of electricity in a specific property that you can sell. What they did is they went to homeowners that had moved into homes where they had seen a default and simply sold the power for less than the utility, and that converted really, really well and serviced those financing options. Cents on the dollar is what they reported in 2014. So, what we are really excited about with this asset class is not only is there this underserved need in the commercial market, but there's also this really exciting kind of emerging asset-backed dynamic. It's really one of the most exciting ABS categories in a generation, in my opinion. You have this combination of those two leading to what, obviously we're doing it, so we drink the Kool-Aid. We're really excited, but what we think is a really strong combination for investors. So a few more details on our most recent fund. So we launched it in October. We've already launched 12 million into it to date, and that's kind of increasing by the month. As I said, it's got a 5-year term, 7.5% projected annual return, and a 20-year amortization schedule. So just to be really explicit about that, if you have a 20-year amortization schedule, and you can go look it up on any, on any internet website, it's a standard 20-year amortization schedule. When you end your term in year 5, you will get projected 86.9% of your principal back in a windfall payment. So basically you're getting about 13% of your principal paid back over the course of the 5 years in small increments month over month. And that's really so the borrower can start to pay down the asset. We don't want that asset depreciating and us still being exposed at 100% level. That actually has some bad kind of LTV dynamics and those sorts of things that we don't like for you as investors. Basically, the vast majority of your principal is at work. The majority of that 5 years, you're getting that projected return on whatever principal is outstanding. And at the end, you're getting this bullet payment or windfall payment. We talked a little bit about that below. And then speaking to just what we're seeing on the borrower side. So I mentioned a little bit about the volume we've raised into this new fund, 12 million in the last, I suppose it's now 4 months or so. Which is great, but we're actually seeing a lot more borrower demand than we have capital to go out and finance. So apologies that this number is a little dated. It's been kicking around 100 million. Didn't get a chance to update this since October, but we're seeing more than $1 billion of borrower demand across those 150 plus partners in 30 states. And so speaking to that underserved nature of this market, we have partners around the country that are all sending us, some really great creditworthy attractive projects by our analysis. And, we feel like we have a lot of opportunity to deploy more capital into this borrowing demand we're seeing and still keep a really high quality of those off-takers in those projects. So I talked a little bit about our dealer network. This is our most important asset. This is our most important relationships, honestly, as a business. These are the folks out there on the ground getting these businesses and municipalities and universities and hospitals excited about going solar. Without them, we wouldn't have a business. And they bring us these great, businesses and projects to bring to you and wrap into our funds. The one thing to know about them is that we are really selective about who we work with. So we only have about a 30% approval rate of a partner that applies. So, as a company that wants to grow fast, it's tempting for us to work with any installer that comes along. But we really want to be working with the folks that are building high quality systems, because when that asset backing is so important and you're betting on that system being there producing electricity at the levels it should be in year 3 or year 4, you need to know the person building it is of the highest quality. And that really is why we're so selective there. The other point about why they work with us, besides that we can do these smaller deals, is that we are dramatically faster than some of the other options they might be able to put something together with. So you might have a local bank or a credit union that if you put up a piece of property, they'll figure out how to do this for you. But even in those cases, probably a more complex structure, more importantly, 30 to 60 days at the least to get that deal structured, whereas we're committing to 5 business days. Once you have your deal submitted, we're giving you an offer. And that goes back to the same reason we can do these smaller projects, which is we're automating the pieces that should be automated of this process and leaving humans in the key pieces like risk analysis. Yeah, and finally, just to speak a little bit to the team that we put together, and there's 16 of us, so we're just highlighting a few of the senior team members, but we're in this kind of interesting combination of we really need to understand how to underwrite businesses and how to perfect this collateral and how to put together these funds and navigate the regulatory dynamics. And I spent 4 years actually as a venture capitalist in New York investing in some of the leading companies in commercial lending, including on debt capital. On the energy side, Dave Reese, our CTO, joined us from the Department of Energy's top national lab out at Lawrence Berkeley, actually working on some of the demand response dynamics that the California utilities were looking at to deal with this explosion of solar. So he literally saw on the ground that residential was growing like wildfire and commercial just simply was not taking off in the same way, and started digging in. And then finally brought in Cam Ramey, who was our first hire, as co-founders. We realized this was a key need, really around the forensic underwriting of the project. If you're gonna hang your hat on the asset-backed nature of these securities, and really the value of that project, you need someone who is, knows all of the ins, the outs, the edge cases, that these things, kind of fail by or fail through. And Cam actually joined us from a group called Cadmus that goes and does post hoc kind of forensic accounting for the biggest utilities and states in the country. It's this niche consulting industry that Cadmus kind of owns. And literally was the guy out there 2 or 3 years out figuring out why some of these systems broke down and what happened and what hardware was working, and what the best practices were in builds and all those sorts of good things. So those were kind of the 3 key skill sets that we felt we needed to bring together. And the last one is we've got a deep bench of software engineers, really led by Dave. He was a software engineer that joined the DOE to lead some software efforts to build demand response software into the grid. So that's his background. But the other kind of key piece of DNA, given what I've talked about and what we do, is a engineering team that includes folks from places like Apple, where they were senior engineers. So that's our group, and would love to hear questions that you guys have, or the moderators here have. And here's the obligated legal disclaimer.
Sorry. Yeah. Oh, yeah. Well, we need to read that. No. So we need
yes,
5 minutes for it. No,
let's spend some more time here. Yes.
Cool. Well, we have some. We have questions coming in a chat format and in the Q&A. I'll just quickly start with a couple since these just came in. First of all, your projections on the cost drop of solar in the different states, without the cost, what the cost of solar will be without subsidies in these states.
Yeah.
So we recently published an article. There's Bloomberg New Energy Finance had projected 2 years ago. They projected that the cost drop in solar modules, conventional solar modules, would go from 62 cents a watt to 21 cents a watt by 2030.
Right.
And then and now in 2 years it's dropped to 40 cents a watt. So this was a shock. They were shocked.
I saw that.
Yeah. But it's just the technology, and obviously in the U.S. the big challenge is the soft costs.
Correct.
So I'm wondering how you're modeling these cost drops in general, and how you're seeing the soft costs coming out. Of course, the hardware costs are going to keep coming down, we expect. But how do you see the soft cost problem getting cleaned up, getting cut?
Yeah, I mean, I think there are 2 ways to look at that. And I would, I always think about Moore's law, right, in semiconductors when I think about, continuing the solar, particularly the solar hardware, to your point, cost curve. So I think, you can look at the historical track record in this industry and how consistent it is. And I think maybe not have a incredibly strong modeled position of exactly where that comes from. And yet know that historically, decades over decades, the solar market has been able to hit those numbers. And so a lot of what we're doing there, frankly, is that we've been in the market for 5 years. We have, 155 partners, $1 billion of deal flow with pricing. And so we have a really nice pricing database, frankly. And when we just simply extrapolate what has happened over the last 5 years to the next 5 years, that is the result. Now, that said, I have opinions about soft cost. That's not where that analysis is coming from. But my opinions about soft cost is that, particularly in my space, and I'll speak to commercial because I know it best, there are still enormous customer acquisition and customer engagement efficiencies. I think there could be 2 or 3 more wonders that I would love to bring more attention to the space. I do not mind the competition. There's still a lot of soft cost around financing that needs to be solved for. And some of that, frankly, is on the secondary side. We need to have a much more liquid secondary capital market like there is in residential that really helps you on the front end have great financing and a lot more of it. I think you'll continue to see the construction folks doing smart folks like they do, more prefab, more microinverters, more really cool tools that have brought, average home construction from what used to take a day and a half, 2 days for the average home 5 to 7 years ago. Now you can get 3 or 4 in a day if you're efficient. We've seen similar efficiencies. So I think it's all of that stuff. I don't think there's some huge,
and it hasn't been that long that this really became a part of the roofing business as well, where it became more of something that roofers were looking at instead of just a niche market. So we've got from an attendee, how are the new tariffs affecting the cost of solar and the 50% reduction in price, your timeline for all 50 states being competitive without subsidies? Of course, those are the Trump tariffs.
Yeah, of course. We wrote a blog post about this. If folks are curious, the title will give away my point. The title was 2017 all over again. And I think that's even a little conservative. In short, if you look at what folks, that aren't just looking at the headline 30% number, but flowing that all the way through to what our customers actually pay, right? The actual cost of the system, 5% or so seems to be a triangulated number for distributed systems, right? For on-site systems. Now, utility hardware is a bigger portion of the total, so it's more like 10%. But, sitting here in my shoes, February 2017, we were seeing 10 to 12% more expensive systems. So when you tell me the system price is going up by 5%, I say, okay, let's go run our model of July of last year, right? I just go back 6 months. So I'm not quite sure exactly. I mean, I suppose there are some places where solar was about to get cost effective and it's not quite going to get there for 6 months, and people made investments in businesses, and I feel for them. But this idea that the solar market is somehow going to choke on this price increase of 5% when the cost went down 10% last year just seems odd to me, because we were all there in July and we know what systems make sense and how those penciled and what geographies make sense. And, and the market was, at least for commercial, really strong. We had like 26%, I think SEIA is reporting, growth in commercial last year. So, we think it's a 6-month hiccup. That's what the pricing data tells us. That's what folks like Goldman Sachs have estimated on the price impact side. So I suppose you can move that graph over 6 months, but that doesn't seem like a big deal to us.
Cool. And I'm sure that will give a lot of people some relief. So next question from Dwayne Peterson. How does Wunder apply ITC? Is it true that you take the payment of the tax credit amount the first year, but don't apply it to the loan balance until the loan is due? That's the full question.
We don't do anything with the ITC, so I don't quite understand that second piece of applying it to balances, et cetera. We issue debt, and the reason we do that is because individual investors at like a 98% likelihood cannot use the ITC. And so when we went out to crowdfinance and build, the biggest alt lending platform into commercial, and knew we were going to go give this opportunity to investors in the country, you really can't bring the ITC to individual investors because 98% of them can't use it. The reason being, if you're an individual, you can only use the ITC against passive income liability, which is a very specific type of income that most people do not have. So we really didn't have a choice as it relates to using the ITC or not, if we were going to build the business that we did. And so because of that, we simply do loans. We're not the owners of the system. We don't get the appreciation. We don't get the ITC. That's generally captured by the business that we're lending to. And the beauty there, if folks are interested, is that corporations can actually use the ITC against ordinary income. So any business that we're going to want to lend to is going to have profits that it can offset with that ITC. And that tends to be a much more elegant solution than us trying to figure out how to place that tax credit.
Cool. And next question, could you explain the difference between your firm and, say, Sol Systems?
Sure. We don't see a lot of competition in the market that we go after, that sub 1.5 million. So we don't pay a ton of attention, to be honest, to folks that do a little bigger systems. In my experience, the 1.5 million level is kind of set by folks like Sol Systems or Open Energy Group or Generate or Seminole. There are a bunch of really, really great firms that have really spectacular energy finance professionals, but do not use software in the aggressive way that we do. It's not the DNAs of their teams. And because of that, sometimes we see those folks when we go up and might look at a $3 million project, which we're happy to do. We talked about the market opportunity below 1.5, but if a great partner has a system, we'll take a look at bigger systems. And we'll see them sometimes, but we never see those groups, and I listed a bunch of them there, on projects below $1 million if they're not grouped together. If there's 7 or 8 of those and you can underwrite one entity, let's say a school district with 7 schools, that's the exception to that rule. But if you're doing a one-off system, you got to do all the work just to make a $500,000 loan. I don't know of anyone else that competes with us. We are in 30 states and we never see anyone.
And I'm not sure if this is a question for you or a rhetorical question, but it's, who buys panels at 40 cents a watt? do you have a response? Because I just mentioned this, that it had dropped to this, the average tracked by Bloomberg New Energy Finance. I mean, I'd say it's the large utility scale project developers. Do you have any commentary on what your size work, what prices you see for panels?
Yeah, there's a pretty big range. Obviously, the volume you're buying at, the extent to which people purchased ahead or were able to purchase ahead in warehouse, right, which we've seen a good bit with our bigger partners that have the lines of credit and the balance sheet to pull it off. We certainly don't see 20 some cents at our scale. I think if you're in the 40s, you're doing pretty well, but there's some real variation.
And is a question, is that anyone doing what you are in the residential sector, or are the projects just too small? Question from Stan.
Nothing to do with the size of the projects. There's just not an issue in the residential sector because 95% of homeowners have a FICO score. And so most of what we do is take the complexity of looking at a business, potentially several sub-entities. There are lots of different business types. Underwriting a business just has a lot of complexity that underwriting a person does not. And it's the reason why I can get a free FICO score at Chase or Amex. And only about 10% of US businesses have a commercial credit score from one of the big three rating agencies, S&P, Hoovers, and Moody's. So there's really just not an opportunity for us to do what we do in the residential side because frankly, FICO kind of does it.
And what is the monthly return on a $10,000 investment? What's the payment at the end of 5 years?
I would need to pull up our calculator. It's on the website. So whomever asked that, feel free to hop over to wundercapital.com and punch it in. In terms of what you'd be returned, it's, as I said, 86.9% is the projected bullet payment at the end of year 5. So I can do that easily. On a $10,000 investment, we would project you get 8,690. I don't know what this, I don't know if it's 90 or 92, but in that range dollars back in your bullet. And again, on the outstanding principal throughout, which go look at any amortization calendar to see what that looks like. But basically you average about 93, 94% of your investment is outstanding because it starts at 100 and dips down to 87% by year 5. And you're making a projected 7.5% yield on that outstanding principal. So you can kind of back into take $93 or $9,400, multiply it by 7.5, and you can see the projected interest over the life of the investment.
And the last one from the queue here for now, any special requirements for financing assets such as freestanding smart flower solar systems versus rooftop assets?
Yeah, we're huge fans of all those really cool novel applications, but we are not interested in exposing our investors to that kind of risk because the assets are what we back, and there's only one type of solar that has 10 years of track record and internationally reinsured warranties, and that is your standard issue rooftop PV getting cranked out of huge manufacturing centers. So although we very much applaud the efforts of folks doing applications, that is not the kind of thing that we're interested in putting our investors in, simply because those assets have not been substantiated anywhere near as well as the very standard stuff that we've been doing around this country at scale for quite a while.
And I think with just one or two more questions. So, you showed the interesting graph of the sort of unserved commercial sector. Talked a bit about that. What's the difference between serving, between serving, the market you're trying to help right now and the smaller, going smaller and smaller? Do the challenges change, or is it basically the same thing, just different, more distributed?
Yeah, it's fundamentally the same challenge. As I mentioned, folks shouldn't equate project size with how creditworthy these people are. There just are some small systems that really creditworthy entities put up on buildings like municipalities. So it really comes down to what we've innovated on, and the reason we can do small systems today and other folks we don't see competing with us there is, as a financing entity, you generally make your money as a percentage of the total that you lend. So we make about a 2%, sometimes a little bit higher origination fee from the borrower, very standard kind of closing fee. Most closing costs on a loan or origination fees. That's the only thing we take. We take an ongoing servicing fee, again, pretty standard commercial stuff, both on the borrower side. if you're doing a $500,000 loan, you are definitionally making 10x less revenue than if you're doing a $5 million loan. And so your ability to do all the work that you need to do to onboard a customer, collect data about them, underwrite them, execute the loan, and service it, you being able to make money doing that on smaller and smaller deals really just has to do with how efficient you are in doing those steps. And so our ability to do smaller deals now is driven by our kind of facility with automation and software and data tools. And as we get better at those things, we can do smaller and smaller projects.
That's what I was going to ask. I mean, that's what you do. That's your specialty. And you expect, I mean, at some point, is there a level where you almost have no additional cost for a client, no matter how big or small, or is it always going to be a number of human steps that sort of that add that cost?
Yeah, we believe really firmly that there's some really important human steps when you're talking about the work that we do, and therefore there is a limit. I don't think
not even artificial intelligence going to come in.
Okay.
Maybe when we get there, yeah.
When we are all replaced in our roles by AI, then yes.
Okay.
We'll be up in our spaceship, fat with our little recliners.
But then we've got some serious issues to worry about with elections.
We've got separate issues. Yeah, when it's Wall-E future, we've got separate issues. But no, there's just to be really explicit about that, because I think it's important, and we learned this actually too well as investors in the 2009 credit crisis. There are people that have tried to fully automate business underwriting and pull humans entirely out of it. And the fact is there are just too many variables, too much qualitative data, too much contextual data that we believe really firmly that particularly that needs to be led by a human. And actually, if you think about us compared to traditional project finance firms that do big deals, the most familiar thing that they would see in our process is a specific, highly qualified financing director leading a deal, taking it to an underwriting committee, walking through a process of discussing it, getting approval, having to do additional research, like that we do. And I don't think that ever changes. I think that is a critical piece, to your point, until AI is smarter than we are in looking at that kind of stuff. But that means we're all just out of a job anyway. So like different problem.
Yeah, we're going to have a lot of it. So another question here from the chat. You have talked about investor returns, but what are the business customers paying? What is their interest rate based on, and who gets federal tax credits? I think
Yeah. So just to be really clear, we don't take a spread. So our borrowers get exactly what our investors are projected to yield. At least we try to keep those really close. So Wunder is not sitting in the middle trying to pay you X and give borrowers Y. As I said, we make an origination fee. We make a servicing fee to the borrower that's fixed and flat, irrespective of rate of the loan. And we make a small investor fee. That we're launching actually in a few weeks. So if you're interested, by the way, get in before it starts, because we'll grandfather you. But that's our business model. So when you come in, just to be really explicit, if you come into Wunder Capital 5, our most recent fund, at 7.5% projected returns, we're going to build that debt portfolio to return 7.5%, maybe a touch higher. Sometimes we'll be like 7.6 or 7.7, just to be conservative about it. But basically we're going out and lending at the rate that you're making as the investor. And then I think we talked about it, but the owner of the system is getting the investment tax credit, which is not us as the lender. Very similar to the way that you own your house, but the bank has a loan to you and could claim it if you don't pay them. That is the relationship that we have. And just like a home, you get the mortgage interest deduction if you're the owner. So
that actually leads into the last, I think, complicated question. Typically, the commercial property will be subject to first liens. If a lender forecloses on the underlying building and land, what will be the effect on the solar's lien position?
Yeah, so first of all, you don't want to remove solar systems for recovery reasons, but we very much have the right to. And so if it enhances the property because it provides cheaper power, there's not much of an incentive for the owner of the property to force your hand in removing the system, which you absolutely have the right to do. So we do a few things to get out ahead of that, like have the owner declare it a piece of personal property. The fact that it is easily removable and we no longer puncture roofs actually really helps with that kind of fixture versus personal property conversation. And when you have a UCC filing against a piece, against an asset, you have very clear claim to it. It's just a question of how that's adjudicated. And so what we've seen is that if you have good systems that the economics work, property owners are excited to have you on their building, and that tends to be an easy conversation. It is true that they could force your hand in removing the system, the building owner, but that really leads to just a different recovery scenario and a minority scenario, kind of case of outcomes, as opposed to being a real kind of thorn in our side.
I think we might be out of time, but we have a quick one here. I think the answer is going to be one word. Would you finance a solar plus storage system?
Absolutely. We actually design our funds to allow for up to 30% of a loan to be non-solar but collateralizable assets, and we have storage explicitly in mind when we made that carve out. So yes, we are very excited about PV plus storage.
And actually, how much do we have? A few more minutes for a few more questions, or I know we started early.
Good for me.
We're good. Start early and late. It was okay.
Are you
looking? Are you looking at projects out of the U.S.? If so, which regions are you focusing on?
We are not, simply because generally capital bases get comfortable with the regulatory dynamics in their own market, and so because of that, the natural extension for us would be into probably the EU. The largest kind of capital base that has consistent regulation on this. I'll just say quickly that because of the financing dynamic and us needing to bring real capital to this market, the developing country market, though incredibly exciting, I think is a tough one to crack with our model. I think it's going to have to be someone else with a different model that figures out how to do that work.
Yeah, and I mean I'm on the Zayed Future Enterprise Review Committee, and we've been covering it for 7 years or something. There's so many actually small and medium enterprises and also nonprofits servicing those markets. Actually quite interesting. But I mean, even in terms of Australia, UK, it's just such a different regulatory market that I think we've seen that before, that you have to do everything again, more or less, right? I mean, you have to go through so much of the same the foundational processes again for different countries, right?
Yeah, I mean, our expectation is that certainly our expertise, our software, et cetera, transfers. But to your point, you're really starting from zero on regulatory understanding. You're starting roughly from zero on capital base. You might have a few folks that play in multiple markets, but you're probably starting from zero on getting the institutional capital markets excited about you in your market. And then finally, you're certainly starting from zero on building the installer network that actually brings us our borrowers, right? So yes, you might not be starting from zero, but you're rebuilding a lot of the business, moving international.
Interesting customer question here. Any chance of bailing from an investment after 4 to 5 years? So I guess what happens if someone decides they need to get out of their investment?
Yeah, so like most of these platforms that match you with a loan, there's no mechanism to go to the business in year 3 and ask them for their outstanding principal before the loan's due, in the same way that a bank can't come to you on your mortgage and ask you for outstanding principal on your 30-year loan. So when you're participating in these sorts of structures, there's not really an opportunity, and it's really simple. It's because you're paired to a loan that no one would sign up for if you could walk up in year 2 and make them come up with all the cash, right? Like that's just not anything that's going to get accepted by the borrowers. And so it's just not something that we, or frankly other platforms, are able to offer.
So it's 5:40 p.m. here in Central Europe. So one last question and we'll close out. From Daryl Tang, does an investor in your fund have an ownership interest in a particular solar installation or an ownership interest in a number of installations?
Yeah, so the way we do it, and this is in the US, is how Lending Club kind of laid a lot of the regulatory groundwork here. It's called in terms of how you pair people to these debt portfolios, and it's called a payment dependent note. And it's the only claim against our fund's assets, or these payment dependent notes. And basically what it says is that you're going to take my proceeds from the sale of this note, and you're going to invest them in a asset that creates payments in the way that is described in the offering memo, for example. And given that that asset pays, that I have the claim against those payments. The little bit of novelty we brought to that structure is, instead of a one-to-one relationship, we have investors diversified into, in our last fund that closed, the term fund, our third fund, 50 projects around the country. And so they have 50 different projects that are paying their monthly loans, mostly interest, as I say, a little bit of principal. And given that those all pay, all of those note holders have a pro rata claim against that diversified set of cash flows. And so basically, in a very tactical way, when you put capital into the fund, there is a project that it funds. But what we really love about the model is all the historical projects that have been done before you. When you come in and get a pro rata share, you get the virtue of all of those projects in terms of diversification. Whereas your new capital allows those historical investors to get an extra project that diversifies them. And so you get diversification against both all the projects that have happened before and all the projects that will happen after, and you have your pro rata share and no one else has a claim against it, just to be really explicit. It's a very straightforward structure.
Well, thank you. You've answered all the questions. It seems very well. So you're good. You're good at that.
Thank you, sir. That's what I do.
Thank you for sharing. This is a topic that we get into, repeatedly for years. How different avenues for investment, how that can open up new markets. I know there's a lot of people. I'm sure there are a lot of readers, even on our own central CleanTechnica team, who are eager for an option for smaller scale investors. Right now you obviously serve a certain tier. So I hope that's maybe in the medium or long term plans, or
it pains us so deeply. Yeah, it's terrible. It's terrible, right? We have to turn people down every day.
I'm sure. Yeah, you must.
It's not fun for us in any way. So no, we are anxious consumers of new information about how the SEC is going to regulate spaces like ours, where we think that there's a great case to be made that there might be room for a little more flexibility to allow a wider range of investors to come in. But as it stands today, in all their wisdom, we, as you say, can only take investment from accredited investors, and we stick very closely to the letter of that law. So unfortunately,
it's such a complicated framework. It's obviously hopefully we get SIA to do some good work to open up more, to do all this backroom legislative work to get more markets available for this kind of thing. But we love it. Thank you.
They're getting good at that. They're getting pretty good at that, right? Tax bill, tariff, like they're.
Yeah, that's who we got to get doing it. Yeah. Thank you very much, Andrea. Do you have anything else to say?
No, I just thank you again to Bryan and to Wunder for joining us on the webinar, and thank you to everyone who joined in. And thanks so much, Bryan.
Thanks, everybody.
And we'll publish this on Facebook and YouTube later on.
And on
Thank you very much.
Too.
Of course, back on CleanTechnica again. Yep.
Great.
Thank you very much.
Thanks,
Cheers.
everybody.
Bye.